But meanwhile, we are looking at the Shanghai stock market. Today, I'm looking at the kind of performance that these stocks have done in the day gone by, in the session that we've had. It's up more than 5% year to date. Also, if you look at it, it's done pretty okay. The Nifty is down almost at the same tune. As far as the Nasdaq is concerned, I'm looking at its performance as well. And the Nasdaq is up almost 10%. The FTSE is up in high single digits. So, yes, we are seeing what this means as far as both developing China is concerned and really advanced US. Both are delivering impressive returns on stocks. Bears, meanwhile, have firmly held Indian stocks in their grip, like I started out by saying. On the other hand, you have active traders on the stock market. The NSE has dropped below 35 million from the high of almost 38 million, and this in the middle of 2022. So the real question to ask is, what is happening to India's outperformance story? Are these numbers, what we are reading right now, are these a cause of concern, or is this a temporary blip? Well, like an Economic Times headline I was reading was screaming out, 9 lakh crore rupees gone. Why the Sensex has gone down 2,000 points in 7 days is what that article was addressing. It said the fear gauge index, the India VIX, has shot up another 5%. And this as selling has been seen across sectors, IT, metals, media stocks. They've all lost out in a big way in the bargain, and they've lost anywhere between 2 and 4 percentage points each. So what's with this downtrend? Is it going to last? Are we expecting a major correction? Let's ask Gautam Kalia. He's the Senior Vice President at Sharekhan by BNP Paribas. He's joined by independent market expert Mahantesh Sabarad, and also the CEO of Moneyworks Financial Services, Nisreen Mamaji, is with us. Our guests on the show, very warm welcome. These markets really, they haven't been very kind to retail portfolios of late. Mahantesh, these markets have been taking this consistent fall, like I was telling our viewers. We are underperforming other emerging markets as well. What are you putting it down to, and do you think this is going to keep happening? Are we going to see further drops in times to come?
First headline number that I have been noticing is that the Shanghai Composite Index has performed almost 6% plus relative to the 6% drop that Nifty has seen in the past 3 odd months. So that's a huge outperformance. In fact, this outperformance in a way has begun since December. And I would attribute that outperformance to the fact that China's economy is now opening post-COVID. Remember, India opened up much earlier relative to China, and therefore a lot of foreign money is getting directed towards China. So will this performance outperformance of Shanghai and the underperformance of Nifty continue for some time, some more time? Probably yes, because we are still in the rate hike cycle. If you remember, even the US is in the midst of a rate hike cycle. We are about to near the end of the rate hike cycle. Only then will we be able to have a better grip on the performance ahead and the surety that probably stability would have come back to Indian markets for it to outperform again.
Is this underperformance only in relativity, which of course is something that you would do when you judge performance? But Gautam Kalia, do you think retail investors are going to get spooked by these stories and the rise that we've seen month on month in SIP inflows? Is that going to start ebbing now? Will our returns on mutual fund investments start showing these declines as well? What's your reading?
Right. So I do believe that retail investors will gradually begin to blink. I do expect retail investors to start reevaluating their choices as far as continuing with additional SIP allocations. If you look at just the lump sum flows over the last 6 months, the first 6 months in 2022 were positive for the industry in mutual funds, and then the next 6 months have been negative, which basically means that more and more redemptions have started taking place. People, especially on the retail side, retail investors have started withdrawing more of the money and finding other places to allocate. And we have to remember that if interest rates go up, then relative attractiveness of fixed deposits becomes, a real choice for retail investors. And if there are micro markets where real estate starts to do very well, then that becomes, I think, in many places, just the preference for physical assets is so high that also becomes a real choice. So I think you could see a reversal. Though I do believe that retail investors, with the access of information and knowledge now, are becoming smarter. They're more mature. They understand that the compounding effect over the 5-year period. They understand that they need to stay invested. But I think in terms of fresh allocations, we may see a slight reduction.
Nisreen, Gautam, Kalia is talking about real estate as a sector, and we keep talking about the need for spreading risk across asset classes. How do you see investors rejigging their equity and debt investment portfolios, and what are you suggesting that they should do in the kind of environment that we're in?
Was that question for me?
Nisreen, yes, for you. Nisreen, please go ahead. Nisreen, can you hear us? Okay, we'll try and connect the audio with Nisreen in a moment. Gautam, Kalia, do you want to take that question? In terms of, the importance, like you mentioned, real estate as a sector, but clearly the importance is to spread one's risk. How exactly do you think one should do that? And also the importance of hedging one's risks. And of course, as far as portfolios are concerned today, the risks are plenty. Wouldn't you agree?
Yes, so in fact, asset allocation remains the first port of call for all investors. So we keep reminding our investors to focus on developing a financial plan, and to a large extent, wherever possible, sticking to it, regardless of market movement. So if you're, let's say, in the I would say accumulation phase of your life, where you are now trying to build wealth, then this presents a good opportunity as an investor for you to build up allocation, build up exposure to equity. But if you're in the divestment phase, maybe you are working with a income generating portfolio, maybe you are looking at some form of retirement income or stability, then obviously with the high interest rates, relatively speaking, this is a good opportunity for people to move into short-term debt space, short end of the yield curve, and kind of invest in more debt-focused instruments. So the relative attractiveness of debt is increasing, and depending on really the individual's view, that's what we are suggesting. And typically when we talk to clients, most of them have maybe 70-80% allocation to real estate and gold already. So then the conversation generally becomes more about increasing allocation to financial assets through mutual funds.
So those are some of the ways. Mahantesh, I'm asking you specifically about what I was hearing about the El Nino effect as well. The IMD predicting a strong heat wave in certain parts of the country, in central and northwestern parts as well. Clearly, the monsoon is going to get affected. How much of an impact do you think this is going to make on food inflation, for one? Because you started out by talking about interest rates, and we are still on the cycle where we are going to see these interest rates getting pushed up even more. So how will the markets fare in light of this information coming in on the weather front? Earlier this evening, we were hearing from the IMD.
The effect is typically known to cause monsoon disruptions as far as the Indian subcontinent is concerned. But remember, the background here for this year has been that we are into a record food production year. We will end the July to June year, agri year, with record food production, particularly on the cereal side. And this should keep our outlook for the next year a bit more comfortable. If there is a disruption in the monsoons, typically we find that the agricultural output has a lag effect to the monsoon by about 2 odd years. It's not just 1 year, because you have also reservoir capacity to look at how the reservoir capacities end up at the start of the monsoon. So I would still say that right now El Nino effect will not cause a disruption, at least in the immediate next year. We should be prepared for it for the following year. For investors, the current concern should ideally be, when will the interest rates cycle end? Because under a 12-month kind of period, we already are up to 2.5 percentage points in terms of policy rates. 250 bips is the rise under 12 months in terms of interest rates. And Suddenly fixed deposits are competing against mutual fund investments as far as retail investors are concerned. So I wouldn't place too much of an importance to El Nino right now and will take a rather fresh call towards the start of the monsoon.
Fair enough. So we'll wait a little longer to take a call on that. But yes, we are looking out for how this rate cycle is going to end, the upward trend. Meanwhile, Nisreen, I don't know if we've managed to connect with you. Can you hear me?
Yes, I can.
Excellent, Nisreen. So, a pocket of market watchers believe that we are already in oversold territory. Yes, how much is the valuation story of India compared to its peers among emerging and other markets? How much is that affecting investors? Do you see them switching out of their long positions?
So actually, not really. I think where the emerging markets are concerned, and even as if you compare the GDP from 2014, we were the 10th largest economy in the world, and now we're the fifth. And in 2028, we will target to be the third largest, economy in the world. So considering that, I think, retail investors need a lot of hand holding because I said, as Gautam earlier also said that, investors are trying to stop their SIPs or shy away from the equity markets right now. But I think a personal finance professional or a certified financial planner could possibly handhold them through periods of crisis like this and ensure that the SIPs are continuing. If you consider like even a 1,000 rupee SIP from 1979 is yielding about 3.5 crores right now with a compounded annualized growth rate of about 14.5%. And the amount invested is only 5.26 lakhs. So I think, if we do our job right and continue to handhold investors in periods of uncertainty like now, then we will be doing our job correctly and ensuring that the rupee cost averaging and the power of compounding works favorably for our investors. Having said that, for any investor who is basically a little risk averse, and who wants, instruments like fixed deposits in the mutual fund space. So we are offering a range of target maturity funds right now, which have the tax arbitrage. So if you continue to stay invested for, about 6 years, or you will get the benefit of indexation, where you will barely pay any tax at all. So you would be, yielding at least 7.5% over that period, which I think, net of tax is very attractive. So we have banking and PSU funds, we have target maturity funds. If you want to add a little bit of risk, you can also go in for credit risk funds, which have about 20 or 30% of AA paper and thereby increase your yield. You can go in for a long duration fund, which has an average maturity of say 10 to 12 years. And of course, you can, redeem earlier than that. So there is a whole bouquet of instruments available to the retail investor who is risk averse. And at the same time, if you are investing through the STP route or the SIP route into the equity markets, as per your risk tolerance and as per your own comprehensive financial plan, whether you're investing for retirement, whether you're investing for your child's education, or a shorter term goal like investing for buying an expensive purchase or a car or a foreign holiday, as per your deadlines, we can create a basket of instruments in the equity space itself to make sure that you achieve your goals. So I think you need a lot of handholding at this time for the retail investor, and we definitely want to ensure that the SIPs are continued, so that you get the benefit of power of compounding. Absolutely.
Absolutely. And that remains a consistent story. But Gautam, Kalia, talking about the current situation, we've seen the earnings in the December quarter, and they don't seem to support valuations. That's the broader takeaway. This outlook should really affect how the stock market performs, especially when you look at the sectors that have been doing well in the past. Banking and financials, if they get further strained, the markets would really get spooked, don't you think? And if so, which are the sectors do you think that one should really be wary of in this kind of scenario?
Right. So banking and financial services, like you said, IT is another place where we are getting mixed feedback from different fund houses internally. Also, we are not very bullish. What I would say is probably, whenever you see such kind of turmoil happening, then you go back to your roots, which is basically playing the consumption theme. and going back to all the companies that are going to be driven through internal consumption, and that's really where we are seeing where we are a little bit more bullish, and we expect further opportunity. Obviously, we expect short-term volatility, but overall, from a macro perspective, as the interest rates hikes begin to stop, and we see that reversal beginning, that's when you expect a market bounce back and kind of upward swing again.
For the short term, we are seeing some amount of pain. And yes, there is hope. And that's when the markets are down. You need to kind of plan better, build your portfolio that much more, and perhaps sometimes being a little cautious and watching things as they happen rather than get into the midst of action. That might be sage advice. This is the takeaway from my discussion with Nisreen, Mahantesh, and Gautam Kalia. Thank you very much for joining us with your perspective tonight on the show. Great to have you with us. Meanwhile, news coming in from the new age